Hi, Lee Phillips. I want to talk about the difference between what we call a complex trust and a simple trust. Now, that's not to be confused of the difference between an irrevocable trust and a revocable trust. Complex trusts are trusts that can accumulate income. Simple trusts are trusts that require the income to be paid out every year. And you probably want a simple trust because if the trust can accumulate income, then it has to file its own tax returns basically, which means it's probably an irrevocable trust. But you don't want the trust to be able to accumulate income because the trust tax rates are horrific. I mean, what is it, $11,000 or something that kicks in at 40%? One of the higher tax brackets in today's society. So why would you have a complex trust that accumulated income? If the trust pays the income out, it's a simple trust, requires all the income to be paid out. If it pays the income out, the trust gets a deduction for the money that it pays out to the beneficiaries. So it doesn't have to pay income tax on that. The place where most people run into this situation is the living revocable trust after the individual dies becomes an irrevocable trust, and it becomes its own taxing entity. It has its own tax ID number. Most of the trusts are written so that all of the income, not the principal, but the income has to be paid out every year to the beneficiaries. That way, it's a simple trust. It does not accumulate income, and it doesn't have to pay tax on the income that it accumulates. It's not a complex trust. And I guess the way you can think of it is, if it's accumulating income, you got a complex problem. If it's distributing all of the income, then it is kind of a simple problem. It's a simple trust.